investing in notes is very capital intensive. You need the capital. A great strategy that I love is leveraging retirement accounts because notes generates tax liability. There's no deductions or depreciation. Tax-free growth.
All right, guys. Hey, welcome to another episode of the Practical Wealth Show. So we're always trying to teach you how to create, there's ways to create wealth outside of Wall Street, right, Fred? And so I have Fred Moskowitz with me. He's a returning guest, so we'll link his previous interview in these show notes today. But Fred, share a little bit about your backstory, a little bit about what you do with my listeners today for people who haven't heard you before.
Yes, thank you, Curtis. It's great to be back. And a little bit about my background. I started out in life as a computer engineer. I had a very successful career working in the tech industry, working at technology and startup companies during a real exciting time during the dot-com boom years. And so through that roller coaster experience of going through the dot-com boom and then the bursting of the dot-com bubble, it made me realize that I was way too dependent on the income from my job. I had one source of income. It was the paycheck from my job, and it was full of all these circumstances outside of my control. And so I learned that no matter how talented of an engineer I was or how valuable of an employee I was, that if things were not going well financially or in the industry, that I could quickly lose my job through no fault of my own. And so this realization made me realize that I needed to start building other sources of income so that I wouldn't be so dependent on the paycheck from my job. It's often been said that millionaires on average have 7 sources of income.
Mm-hmm.
7 sources of income. And for many, many people that I speak with, so many investors, they just have one. It's their employment income. And so what if we talk about and look at how can you add maybe add one new additional source this year, take some action, take a step. And that's something that I'm always passionate about, teaching about how to build cash flow and income, how to make investments where they're focused on owning assets and they generate income so you get paid while you wait.
Right.
That's a strategy I love.
That's it. And so I love that because, I always, somebody, I don't know where I heard this. You could get fired for one of 2 reasons, any reason or no reason at all. Right.
Yeah,
so
that's exactly right.
And so I view that as risky. Okay. But now that being said, so we're not saying jump out of a perfectly good airplane without a parachute, right? Because if you love it, stay there, but you need to have some help that takes the pressure off of your job, your earned income. And the tax code, we might get into this later, favors basically landowners and business owners, right? So
that's
you
gotta, exactly.
You gotta follow, you gotta understand the rules of the road.
The government wants to stimulate and inspire small businesses because it creates jobs and employment.
Right.
They want to
wait, you mean the government doesn't create jobs? I thought the government created.
No, they need us. They need us, the people, the citizens, to do that. To do that investment, create the jobs, create the growth, create the economic engine that is the U.S. economy.
That's sarcasm. That's my sarcasm. Okay, so if it's a new listener, Curtis is being
no, but this is true. You're so right, Curtis. The government incentivizes through the tax code
Yes.
for people to start small businesses and to operate rental real estate. Why? Because small business is the backbone of our economy, and people need good quality housing, places to live. And so, um, what a better
I would
way
point
for
y'all
us than to get
to
involved in
this
that?
on my website. So I have a list of recommended readings. So one of them is Tom Wheelwright's Tax Free Wealth.
Mm,
And the other one is I met him at a conference. I was at with Kim Butler. It was a conference in where were we at? Park City, Utah, right? And he
nice.
says,
Mhm.
this is when he started that conversation. Look, the code is another word for map, treasure map, right? And his second book is the 8 investments the government will pay to make. But if you look at, if y'all have read cash flow quadrants, it's the ES. So you're working for earned income. And the first lesson in Rich Dad is rich people don't work for money, right?
Yeah.
Which means they don't work for earned income. There's 3 types of income: earned, passive, and portfolio, right? And so when you earn, you make, if you are high paid W-2, you earn it, you get tax, they get your voluntary benefits. The rest of it goes into your savings account, and then you spend it. Maybe you save it, but saving is unconscious. So we have a whole conversation around that. But if you look at, what does the government need? They need jobs. They need housing. They need energy. They need agriculture. So they'll incent you to put your capital there to help
Yeah.
get done with what they want done. And then you can make good returns, but you also help your taxes substantially. And so you've got to, so when people look at the big, beautiful bill, I'm going to do another show on this. You're looking at it wrong, because if you're not thinking like an investor, it's not going to do. There's actually got a lot of good stuff in there for the middle class, but it's really designed for investing in business owners. But guess what, guys? No, I don't care what your college professor told you. Our country was based on capitalism, right? It was based on free enterprise. That's why people don't tie themselves to rafts. I'm going to go on. This is Fred as a Curtis rant, but I'm going to end it. But they don't tie themselves to rafts or crazy stuff to get here for socialism. All right. So you you want to get here, you got to get in the game. Those of y'all live here. And so Fred and I are going to talk to you about how to get in the game. So your asset class of choice, so it's 4, right? Business, real estate, paper, and commodities. So would I be accurate in saying that notes, and you tell me the other things you're doing, would fall, it's under real estate, but it's really more on paper side.
Correct. Yeah, I agree. It's
Okay.
paper. Yeah, it's paper. However, it's tied to real estate.
Yes.
If you think of what a note is, it's it's a promissory note. It's paper. It's a debt
Mhm.
instrument, and it's backed by collateral through the mortgage, which is what secures the real estate to that debt instrument. And so you have those two working hand in hand. They work together in order to provide the investment that you want and the security for that investment, which gives you the downside protection.
Yeah. So you advise investors to quote, step into the lender's shoes,
Hmm.
right? How does that shift in perspective change in the way someone approaches risk and relationship building? We just kind of jump right into
Yeah,
the thought
let's
process.
do that. So, what's behind that term is lenders and banks originate notes. They create loans, mortgages, but then what they do is they immediately sell them on the secondary market. And
Hmm.
why do they do that? They do that so they can recapitalize, get their capital back, and then the very next day they'll turn around and create a new loan for someone else. If they didn't do that, they would run out of money
Hmm.
eventually. So that's why these big government entities like Fannie Mae, Freddie Mac exist, because they buy all those loans from the originators of them, and keep everything moving. And so there's this secondary market where loans are bought and sold every day And for us as investors, we're able to tap into that and purchase loans at a discount on the secondary market. And then you are essentially purchasing a legal contract, which is the promissory note. And now you step into the shoes of the lender. You have all the rights, remedies, and protections that are outlined in the note and mortgage. And now you have the right to collect a cash flow stream. So those payments transfer to you and start coming in.
So you make money like the bank makes money.
You do. Yeah,
Yeah.
absolutely. Absolutely.
In your book, like numbers tell the story, right? So you emphasize evaluating notes using financial metrics.
Mm-hmm.
Okay.
Yes.
What are maybe 3 numbers like yield, LTV, default rate? What do you look at first and why?
So, yeah, this is a great question. You're asking about how do we evaluate a note, right?
Yes.
And I have in my book on note investing a whole chapter, the little green book of note investing.
Okay.
Yeah, it's available on Amazon. So we have a whole chapter about how do you evaluate a note, because maybe you're looking at several notes and you're only going to buy one. So how do you choose, right? Well, a couple things you want to look at. What's your timing and risk tolerance, first of all? With any investment, always you want to consider that first. So notes are priced according to the risk model, and in turn, that's going to impact your rate of return.
Let me clarify there for the price, meaning the interest rate. Does that mean?
No, the price meaning
which you would buy.
Well, it's related. Yeah, the price for buying the asset,
the rate is a function of the risk the lender perceives, though. The risk.
It is, yes, it is at the origination time, but
yeah, okay, right.
We're now buying it
we're
in the future.
Okay.
Might be 6 months ago or 6 years ago.
Got it.
Things may change. So the value of the asset is a snapshot in time when you're buying it or when you're valuing it. So you want to consider that. The interest rate is set in the loan documents. That never changes, right? However, if there are additional risk considerations or other conditions, then that can impact the pricing, right? For instance, a loan that was created and has a perfect payment history. Let's say it was originated 5 years ago. You look at the payment history, every payment on time, like clockwork. That's going to increase the value of the note. Yeah. If there's a payment history that's less than pristine, then you can negotiate a greater discount. Maybe the borrower does some kind of seasonal work, and every year around a certain time of the year, they start getting behind on payments. And then after several months of that, it catches back up again. And you see this as a recurring pattern. And so you go into it knowing, hey, there's this condition here, and are you okay with it? Or would you say, no, I'm not comfortable with that. I'm going to go instead buy the other note with the perfect payment history. But the distinction is, if you're willing to take on that additional risk, you can earn a higher rate of return because you'll negotiate a greater discount for that. Right. This is where the dynamics come in. And so when you're evaluating a note, yes, you look at the original interest rate and the payment amount and all that, but then you take your financial calculator and you start to run some different scenarios, because you're calculating discounted cash flow. And so you discount the value of the asset, and it makes the rate of return go up. And that's your
financial calculator that I bought. I remember when I did mortgages. that never knew. I remember, and when you flashback to my freshman year in college with that financial calculator.
Yeah.
Future value, present value, creating a sinking fund. And I remember we had a pop quiz, and I had the calculator, But the calculator came with a book to show you how to do the fun, and I still failed the quiz because I didn't learn how to use the calculator yet. But that's what you're talking about, being able to, I've heard financial literacy is accounting, the ability to read numbers and analyze
It
those
is.
numbers, and that's so like one of the things, Fred, I say investing is really more about becoming something than about buying something. So becoming meaning learning how to evaluate notes, evaluate the metrics. You know, we teach people to save 15-20% of their gross income. And then if you're doing that and then you learn the skill Fred would teach you, then success is when opportunity meets with preparation. So you have the capital and you know how to evaluate a
Yep.
good deal from a bad deal. Was that accurate?
That's correct. That's
Mhm.
correct. And that's what that's what we do. And let's say that you are someone who doesn't have a lot of time
Mhm.
to get into this hands-on, I'll call it, get into node investing at a super hands-on level. And you say, I like notes. I like the idea of it. I like the idea about my capital being protected by real estate, but I don't have time for this. There's a lot of risks and pitfalls, and I don't have time to be evaluating notes and managing a portfolio. And so, a great option for that person could be investing in a note fund where it is a passive investment, and the fund managers, they're the ones that they raise the capital, and then they'll go out to the secondary market, find notes to buy, evaluate them. They have the relationships in place to get access to purchase the assets, and then they'll buy the notes and manage the portfolio and pay distributions out to the investors. And so this makes it truly a passive investment. And for some people, that can be a great option. uh, Both ways are good, but it really comes down to how much time do you have. If you have a lot of time, you want to be hands-on as an investor, great. Be active. Be active as a node investor, build a
If you want to be
portfolio.
your own fund, I knew people that do that. I know a couple people, clients of mine
Yeah.
that do that.
I,
But for most people, if you have a good job and you've got good cash flow, Fred as the fund manager is probably a better choice for you. If you don't want to learn all this stuff, but you got free cash flow and you want to buy an asset that sends you a check every
Yeah, and
month.
so there's a lot of options out there. And so what I always like to teach is focus on building relationships and learning what options are available to you,
Right.
and talk to the people in your circle and learn
Mhm.
and understand what are the different options, and then take action.
Where would they learn? So let's say your book as a resource,
Hmm.
right? Where if they say, look, this is fascinating because it's like a whole. One of my clients is a note guy now. He started at like 26 or so, and then he was like going to these real estate conferences, and then he fell into the sub world of notes, right?
Yeah.
And then he's in love with notes, So he don't even, he don't sell them. He just buys them and just collects. He's like 34 with 30,000 a month of just coming in, boom, boom, boom. So he haven't had a job in like 6 years, 6 or 7 years, and he loves that. He's like, oh, I got 15 different extra strategies, blah blah blah. But I so I love that as an environment. But he had to. I don't think it was just like a lot of stuff. He was going to Texas. He was going to different events. Like if I wanted to begin to research this area
Mhm.
to see if this is a good place for my capital, what would you have them do? Step one, read your book. Then,
Yeah, definitely start with
yeah.
education, right? Read books, listen to some podcasts that are like yours, right?
Mm-hmm.
Learn and talk to people, like schedule some calls, build some relationships. That's how you start.
Mm-hmm.
I would say if you want to be active as a node investor, definitely what you said, going and traveling to different conferences and events. that's where you learn, right? There's a lot of education. And what else? You get to be in a room full of hundreds
Yeah.
of note investors and build relationships with them. And that's where you find notes to buy from
Yeah, I was
other
thinking that. That's where
investors,
some
other
people
note
really,
funds
yeah.
that
Hmm.
sell notes. So it's really a relationship based business. And so that's the way to get started, right? If you're looking at a fund, then you want to develop a relationship with the fund managers, there's lots of different note funds that are out there. And
Hmm.
so you want to find something that aligns with your timing and risk tolerance again, right? High risk or low risk or whatever it is that you need. What's your timing? Do you want steady cash flow starting right now? Or are you investing out of a retirement account where you're not going to need that money for a number of years? And if you don't have the cash flow coming in right now, that's okay. And there's some funds that are more geared toward that. And so
Hmm.
it really is a matter of finding what's the right fit for you and your individual situation. And for each person, it's different. Everyone has different goals, different life s- scenarios, and your age, right? Again, that time horizon, which changes, right? When you're in your 20s and 30s, it's very different than when in your 50s and 60s and
Okay.
beyond. Yeah.
So we're in a currently like a high, I would model see they're saying it's a high rate. In high school I remember rates were like 17%, right? So they don't even know,
Yeah.
you know.
Exactly.
So
Yeah.
but how does that the today's rising or fluctuating, potentially maybe lower yields, have yields and risk profiles in private notes shifted for both active and passive investors? Like how much do they should people be concerned about that? How do you look at that? You know what I
Yeah.
mean?
That's a great question. I I know that changes in interest rates, it doesn't impact the notes that were originated in the past. It
Right.
impacts whatever notes are being created today,
Okay.
right?
Because if it's a
So if
contract, if it's locked in, it's locked in, and they don't
it's
change.
locked in,
Right,
right?
right. Unless you
It
refi.
won't change,
Hmm.
right? And so we're buying notes that were originated in the past, and so, but the thing that does change is the pricing. Current interest rate environment can impact the pricing and returns on those notes, and so that's. But if interest rates go down and notes are being originated at 3% and 4%, that's going to impact the pricing for sure. So that's what we see.
Can
But
you give me an
overall,
example of
it's
that though? Like right there, can you give me like a numbers? Like I got a note. I bought $100,000 note at
yeah.
XYZ%. So if it right, how I want to. I'm hearing that, and so I'm a little unclear on what that means. I'm wondering if I'm, you know, I'm as
Okay.
dumb as the average person.
So let's say you were looking at a note. Um, let's say you were looking at a note that was originated back when rates were 3%,
Okay.
and you say, "Well, I want to buy that note, but I don't like a 3% interest rate." And so what happens is you discount the purchase price uh, using the financial calculator to get to the yield that you want.
So
And the
yield and notes
sell,
is what, like for real estate, that's like cash on cash return.
yeah,
Okay.
exactly. It changes for every individual. And so you can offer that. So the note seller is not going to be realistic if they have an expectation that they have a note with a 3% face value and they're going to sell it at 100% of the loan balance. It's not realistic. So the purchase price will be discounted down to whatever the yield is that the investor is looking for. And
Okay.
then they can agree or not to do
Yeah.
that transaction, right? It's a negotiation.
So for the yield I want, let's say, for example, the note's 100,000, but to get let's say I want a 6% yield, I might need to offer, I'll buy it for 72.
Yeah.
That's what you mean.
Yes, exactly.
Okay. And then you just got
And
to
this,
come to an agreement or negotiate it.
yes, and this is
Okay.
customary in the note marketplace. Yeah.
Okay. I just want people to get an inner workings of how this, most
Yeah.
people don't understand what I call the financial physics, how money is made inside of each of these
Yeah.
stuff. So I appreciate you
It
breaking that
comes
down.
down
So
to the future value
future
of
value, right?
money, of a
Yeah.
cash flow stream. Yeah.
So some of that, see, that's what I mean. That's the language of money, present value, future value, opportunity cost. Those are the things that you just focus on rate. That's just one way to evaluate a deal.
Yeah.
And you be able to look at money that way. And that cut you off from what you were going to finish. You're going to finish another
I was
rest
going to
of that
just
question.
show you this. Hold this up here.
Yeah.
So you see the buttons on the top: PV,
Present value,
PMT, that's the payment amount,
payment.
FV, future value. So this is exactly what we were talking about before. How to take that into account. So yeah,
I love that.
this is an app called 10BII, and it's great. You don't have to have a calculator or carry around with you anymore. You have it right on your smartphone. And I always say this: it's the best $6 I ever spent. It's not a free app. It costs $6 to buy, but it's the best $6
Listen,
I've ever
my
spent, and I use it every
calculator
day.
was like 75. It was like 75 or
Yeah,
$100. Remember when they had that
yeah.
TI, that whole
Mhm.
financial calculator? I said, there's got to be an app for this. Thank you for that. I wrote that down.
Yeah, it's
And yeah,
10BII. If you go
10
in the App
D
Store,
or
you'll
B?
see
B as in
B.
boy,
Yeah.
B as in boy.
Yep.
I. Yep, I got it. And I'm like, all right. I'm looking at the time. I just want to make sure I get what haven't I asked you? I have a couple more questions, but there's something where I should ask you that you want to bring out in this conversation that what potential investors need to know, or that type of thing, or tell me about your company.
Yeah. I will say that let's talk about this. Adding additional streams of income,
Mm-hmm.
it creates financial resiliency in your
Right.
life. And you start to worry less about money, the stress around it. Because let's say you have three sources of income. You have, just as an example, you have your work,
Right.
your employment income, you have notes, or you invest in a note fund, and maybe you have some rental property. Great. Real estate, great way to create income. So you have three streams of income. And so if one of those streams gets interrupted for any reason, it's life, right? Life
Right.
throws us curveballs all the time. Well, if you have the other sources of income to lean on, then you don't have to stress. And instead you can focus your attention and your intention on handling the surprise, the curveball, whatever it is in your life. Maybe you have a health issue and you're unable to work for a few months. To some people, that can be devastating.
Yeah.
Right. But what if you have other assets that you've invested in that are going to carry you through? What if you have cash value in your life insurance that you can lean on as an emergency fund? So
Right.
now you have options and choices in life. And that takes away a lot of the stress. And so this allows you to focus your attention on regaining your health or on resolving the issue that caused the income to be impacted. Whatever it is, you can handle it and focus that. And I think that's one of the best things about having multiple streams of income is it takes away the stress and it allows you to focus the bandwidth, the mental bandwidth and cognitive function on handling the issue or on living your life to the best extent
Yeah.
possible, spending time with your family, whatever that is. And I think that's very powerful and very important. And sometimes people may not appreciate the strength in that.
I mean, it gives you, if you got liquidity, and we call them in our system for cash flow engines, right? So, and you've got access to capital and you've got cash flow engines, and you build we call it a portfolio of cash flow engines, depending on, what you like, what you're interested in, what you want to learn about as you vet it out. Then as long as you don't go crazy and we call it Parkinson's law, expenses rise to meet income. If you can keep your cash flow in check and just focus on financial freedom, which, we talk about, people worry about retirement. I don't care about retirement. Retirement is an age and it means to put out of use, right? Or withdraw.
It does.
Right. So we want financial freedom. Financial freedom is a capacity, right?
Yes.
And so what are your expenses? Do you have assets or cash flow engines that meet or surpass?
Exactly.
That's where your anxiety comes down. That's where what you're talking about, being able to live your life. If you had an interruption from your job left you worked for the government and they decided that they don't need that department, you're okay still.
Yeah. Exactly. It changes your perspective. It does.
And that's what you work toward, right?
It does. Yeah, exactly. And you can continue working in that job because you want to, not because you have to. And so if you need to make a change because of whatever circumstance, then you can do that without fear, without concern, without stress.
And that's where we're, so in this, the considering notes as one of a possible cash flow engine to achieve that, so because I don't know if we met there, but I know you're like, we're both in the Philadelphia area. So you are a regular guest at DIG, which is the biggest real estate investment group in probably the Delaware Valley area. There's little subgroups of that. And when you see these people, how do because a lot of my clients and listeners are real estate investors, where does this fit in their portfolio in your mind from the people that you talk to, as a percentage or something they may want to consider?
There's a couple of ways it can fit. First of all, owning real estate is awesome. However, it's not for everyone. Some people have done it. They've had rental properties in the past and have found that it was a lot of work. And guess what? That's right. It's a ton of work.
Right. It's not passive.
It's not for everyone.
Right.
And so for many people, they say, hey, notes is a great option to be involved in real estate without having to manage properties and deal with tenants and repairs and renovations and all of that. And so that's definitely one aspect of it, but also it's a diversification. It's a diversification of adding other income streams. Even if you like real estate, like myself, I do. I love it. I invest in real estate, but I also invest in notes as well. It's separate income streams. And so that's the way it fits in. But I definitely have worked with so many investors. They say, I've owned this property for 10, 20 years. I'm going to sell it and cash out. And then they want to invest that proceeds into notes or into a note fund. And you know what's the interesting thing? For many, the majority of those investors, the cash flow way higher from notes than it was from owning the property, and they're happy. But now they don't have the ownership responsibilities and headaches,
That's
and
major.
so that's a trade-off. But I definitely have talked to so many investors that they've gone through that switch, and that can be really powerful.
Let me hit this because I have a love-hate with like self-directed IRAs, but a lot of people have a lot of capital. I don't have a hate. I don't like personally, and I learned this from Tom Wheelwright, people promoting buying real estate in self-directed IRAs, right?
Yeah.
Because you're
Not
giving
the
up all the
best.
advantages of the real estate for the income. But I love notes
Oh, yes,
and tax
exactly.
liens and
Yes.
that kind of stuff. So if you've got a lot of capital in those things, maybe you could, here's a way to access that with capital you've already positioned.
Exactly.
Talk to him a little bit about, because I think it's a good cross section for
So
you.
buying notes, investing in notes is very capital intensive. There's no financing for it. So you need the capital. And so a great strategy that I love is leveraging retirement accounts. Maybe you have an old 401k from a previous employer, or you have an IRA that's sitting there idle, which a lot of people do, have them with cash. And so putting that into notes, it's great because notes generates tax liability. There's no deductions or depreciation. And if you can couple that together with the tax advantages of a retirement account, you have tax-free growth or tax-deferred growth, which is powerful.
Right.
And that's something I do personally. I mean, that's a strategy I love. I always
That's what we
recommend
would
that.
do. We would I look at people's situation. Okay, you got this, or you got it in Vanguard, you haven't contributed to it. Okay, here are some other things that you could do. Let me introduce you to Fred, and then you can figure out might this be something you want to consider with this $100,000 or that. What do they, you says it takes some capital. What is the, like on the low end, they should be, like, I've got X. I know that's a little question, but you know what I mean? they want to put a number to this. So I'm gonna
Sure. Let's make this with concrete examples. So notes can be bought with very small balances, $5,000, $10,000 notes, right? That are mostly paid off, but there's a little left. It's not great for the yields, and what happens is the costs eat into your income. So I don't like those for that reason. But notes can be very small, 5, 10,000, all the way up to $1 million or more. Jumbo loans, right?
Right.
And everything in between. And so it's a broad spectrum. If you're looking at note funds, those usually do have a minimum investment amount, typically around 50,000 and up.
Okay.
I've seen note funds that have $100,000 minimum, or even I looked at one that was 250,000. But most common 50,000. There's some that are 25. And it varies. So you need to just look at options. And that's definitely one of the first topics to talk about when you're meeting with a fund manager and considering a fund is what's the minimum investment amount, and is that going to match up and align with what you're doing? But there's no set amount that it has to be. There's just different options out in the marketplace, and so you can look at that and see what's there that can line up for you. You always want to be in alignment with whatever it is you're considering.
Right. I love that. And what do you see? I don't know if it's have a working crystal ball, but does it change that much? So if you were to look over the next year, 3 years, 5 years of where you think the economy is going to go. Does that matter for the note business?
Well, I'll say this, there's always a demand for financing for real estate. That's not going to change. In the United States, the majority of properties, homes, and commercial properties are purchased with some component of financing. So there's always a demand for that. And so the secondary market, it's always there. And so
Because
that's
somebody's
something I
always
don't.
selling those notes after they
Yeah.
originated. That's
And
what you're buying.
people are always um, moving, they're refinancing, right? This is life, especially residential homes. People need to move because they're changing areas, because they want to be in a better school district, or maybe their children are grown and they want to downsize to a different property or move to somewhere that's warm.
Mm-hmm.
And
Mm-hmm.
so people end up moving and paying off those loans and buying a new property somewhere
Mm-hmm.
else. So you always have that activity. You have new families forming, right, getting started in life, and then they want to purchase a home for their family to raise their
Mm-hmm.
family in.
Mm-hmm.
That's not going to go away. So there's always demand for good financing, always a demand for good quality real estate, and that's something I don't see changing.
Okay, I love that. So, Jim Rohn used to say economics is major, right? So and my mentor, who wrote "Becoming Your Own Banker," says if you know what's going on, you know what to do, right? And so,
Nelson Nash.
yeah, that who wrote the book. That's our
Yeah.
textbook. Like our I was just doing with this. So I don't even let clients work with me unless they read the book. Okay,
Yeah, it's a
and
famous book.
because we go, all right. I had a young guy. I was just on a call. He said, all right. I got a question about page 35. All right, let's go there and let's break it down. So because it's your money, it's not my money, right? It's your money,
Mhm.
and so that's it. You want somebody that will, like Fred, to teach you money, and then because when you buy a product, tell me what you think about this. I tell people, look, the product you buy or the investment you buy should be a result of your knowledge, of your study, of your research, not a substitute for it.
Yeah, that's a great point. I love that.
And so that's kind of the framework of how we share with that. Fred, as we close, tell them how to find you, how to follow you, how to,
Yeah.
if they like what they heard, how they could, have a conversation with you if that's a next step. I'd love
Yeah.
to
Thank you.
get
Thank
that
you. I
out there.
appreciate that. So, couple things. How to find me? Certainly through my book. It's called The Little Green Book of Note
Green book.
Investing. You can
Mm-hmm.
find that on Amazon. You can visit my website, which is fredmoskowitz.com. And if you prefer a little bit of an easier spelling, you can go to giftfromfred.com, and it'll take you right to my website. And from there, I have some different resources available. You can connect with me, send me a message. And I always love hearing from investors and building relationships. It's one of the most important things we do. And another thing, if you go to giftfromfred.com, I have a special report on note investing that I'm happy to send to you at no cost and no obligation. I'll send that out to you. And so look forward to connecting. Please do reach out through the website. I always love hearing from investors. People do so many different things, such a diversity in investment styles and strategies, and I always love talking about it. It's a great thing.
All right,
Thank
I'm gonna
you.
put that in the show notes. Gift from Fred. That's an easy way, and it'll
Yeah.
take you where you want to. And the book. Go to Amazon. I'm gonna try to link both of those in our show notes, Fred. And listen, brother, I thank you for
Thank
coming
you.
back on. This
Yeah.
is, the environment changes. You got to revisit stuff, and
Always.
I'm glad to have this at the top of our list again because I think this is a great strategy for a lot of people out there. You got to dig into it, right? I always tell people, go slow, start small, but learn.
Yeah.
And this could be a good thing. Fred, thank you for another fascinating episode of the Practical Wealth Show, guys. He gave you a bunch of writer downers, some books, some thought processes, and just learning to think like an investor. You know, you got to have your money rules, and get his book. And this might be a good thing for you. Remember, there's 4 asset classes: business, real estate, paper. This is paper, and commodities: gold, silver, oil, and gas. So what do you like? What do you qualify for? Some of these things you got to be accredited. I don't think you have to be accredited to do this. Do you have to be accredited to do this?
No.
No. Yeah. So accredited means, I will look it up. I don't feel like explaining right now. So you should know what accredited investor. Let's just look up accredited investor. But Fred, thank you.
Thank you.
Guys, make it a prosperous day. Make sure you reach out, get the book, get his free gift, and learn. Thanks, Fred.
Thank you, Curtis.